Okay, good morning. Let's get started. Good to be with you this morning on the virtual coffee talk. I know originally when we planned this over a month ago, things are much different, and we're calling today the CARES Act and bear markets. Two different talks to go through, but I think you're going to find both of them really, really helpful and what to do in challenging times like this. So let me start out by giving you a warm welcome. Most of your clients that are listening today, big virtual hugs to you guys. We miss you. Thoughts and prayers go out to everyone. Hope everybody's families are safe and healthy. We're good here. We're doing well. Everybody's healthy so far. We're thankful for that. And I know these are really challenging times. So hang in there. And I really think today is going to help quite a bit. So let me dive in, and let me go back to sharing my screen so that we can get started. As I'm getting started here, if you look in the bottom of the video screen, you'll see where there's a Q&A button. I do plan to check in along the way, see if there's any questions, and I'll answer as many as I can, so you can engage with that. So let me start with my purposes for today, and I want you to write these 4 words down, especially if you're not on the conference itself. But the 4 words are center, calm, forward thinking, and faith. And what I mean by faith, think of that as trust and confidence in something unknown or a future. So let me start with center. So what do we mean by center? It means really being aware and focused and thoughtful of what matters to you. What's important, your marriages, your family, your relationships, taking care of your body, those kind of things. So in a situation like this that is so unusual, what happens a lot of times is maybe we're checking in with the media and in the news, which we need to be informed. But a lot of times we can get so drawn in by those other narratives that it knocks us off center, and we feel it in our bodies. We might feel a little bit anxious, a little bit worried, fearful, just jittery, and just aren't able to focus. So I invite you to really think through like what matters and really stay centered on your future and those relationships that matter to you. Second word is calm. So think of calm as like a mood to be in an approach. A way to orient with your life and the people around you. And the reason being calm is so important is we make much better decisions when we are calm. And it usually a lot of times has our relationships go even better. Third is forward thinking. And when we have a big crisis like we're in now with the coronavirus, sometimes the here and now just monopolizes our thoughts, our conversations with others. And with forward thinking means, all right, well, I understand I need to be aware and vigilant of what's going on now, but what about in 2 months? What about in 6 months? What about in 2 years? What about in 10 years? How can I be forward thinking today to seize opportunities? Because remember, every situation is a bundle of threats, obligations, and opportunities. So what are the opportunities in today's situation to set up an even more successful future for us and our families? And then last but not least, I mentioned the word faith. So think of that as trust and confidence. Like how or why should I be trusting and confident in a recovery and in a future? And so I think today, talking through the CARES Act as well as previous bear markets to bring perspective, I think both of those are really going to help, not only with all 4, but really focusing on those last 2, being forward thinking and having faith and trust and confidence in the future. All right, so let me go back to sharing my screen. So those are our purposes. Okay, so quick agenda. We're going to go over a summary of the CARES Act. I've got 7 key areas that I think are most relevant to our listeners and our clients. Then we're going to go into a checklist of what to do now. Then we're going to go to a historical view of bear markets to help us anticipate. And then we'll, again, have another checklist of what to be doing now with bear markets. And then we'll pepper in some Q&A as we work through that. Okay, let's go with the CARES Act first. So here's the first area that I think is relevant for many of you. There are rebates. They are tax credits in essence. So these are non-taxable distributions that are going to be coming out to Americans, including retirees. That it's $1,200 per person, $2,400 for a married couple, and then there's an extra $500 for each child that's under 17. Now there are phase outs to this rebate. So the phase outs are based on your adjusted gross income. So the way to think about this is once you break over the minimum threshold, then it starts to phase out 5% of the benefit you would have been entitled to. So the phase outs for individuals start at 75,000 and then go through 99,000 of AGI. And that's if you have no children. And then married filing jointly starts at 150,000 and goes through 198. And that's when it's fully phased out if you have no children. If you have children, it's a little bit of a different formula. We'll talk about that. Now look down there at the bottom. It says based on your 2018 or 2019 tax return, whatever was filed most recently. Okay, there's a planning opportunity. So if you have not filed your 2019 tax return and your income in 2019 is lower than 2018, then you want to get that 2019 filed as soon as you can, because it may entitle you to more of the rebate credit, especially if you're in that phase out window. So that's a planning opportunity. Be strategic with that. Get that 2019 filed ASAP if your income is lower, 19 versus 18. I also have a phase out example. So let's use Lee and Peter, her husband, and they have 2 children under 17. If their adjusted gross income is under 150,000, they receive the full $3,900. So it's 12 and 12 and then 500 and 500, right? So that's how I got to the 3,900. Now, if their AGI though was higher, let's say it was 200,000, then it's reduced by 5% of the 50,000 above that 150 threshold. And you can see here in the example, it would be reduced by $2,500, which would bring the rebate down to $1,400. So that's an example of how that phase out works. They're tax-free, already mentioned that. They're expected in May. We'll see if the government can pull that off. And 90% of taxpayers are expected to receive some form of tax credit with this. All right, let's go to area number 2, withdrawals from retirement accounts. For 2020, if you have a withdrawal from a retirement account that's virus related, all right, and they define that, then there's an elimination of the 10% early withdrawal penalty. There's also no mandatory 20% withholding. So that usually if you withdraw money from a 401k, they do a mandatory 20% withholding. That's waived here during 2020. So if you need liquidity and you do draw out of these retirement accounts, that 10% early withdrawal penalty if you're under 59.5 is waived for just this year, and then there's no mandatory withholding. In addition, there's 2 other key points. First of all, you can spread the income tax liability over 3 years. So you can pay some in 2020, some in 2021, and some in the remainder third in 2022. That helps out with that tax burden. The other thing is that you can actually repay this. It's almost like a loan to yourself. So if you repay some or all of what you withdrew from the account, if you repay all of that, then in essence, you can get the tax dollars back that you may have paid in on your tax return. So that's a key provision here that if you need to withdraw, you can put it back in and then it's a non-taxable loan to yourself. Yeah, planning opportunity, right? Could be a tax-free loan to yourself. And then here's another one. I'm going to speak more to this in a moment. If you took a required minimum distribution in January, this is a way to get that RMD portion or that money back into your retirement account and make it non-taxable. More coming on that here in just a second. Brings me to number 3, good segue. Suspension of required minimum distributions in 2020. Let me say that again. Suspension of required minimum distributions in 2020. Many of you listening, if you were of age where you were scheduled to have a required minimum distribution for 2020, it is now waived. You do not have to take the money out of the IRA or the 401k. You can leave it in there and it can be tax deferred. It can continue to grow tax deferred. So that's a big planning opportunity. And here's what I mean by that. So possible opportunity would be, first of all, if you have taken out some RMDs so far this year, you can put that back in, and we can use either a 60-day rollover or the previous provision we talked about, the withdrawal from retirement accounts for COVID. Secondly, when you don't take an RMD or you pay back your RMD from earlier this year, that reduces your adjusted gross income and your tax here in 2020. And then what that sets up is it creates space for Roth conversions. So let me explain that. If your income, let's say, is normally 100,000, like from all your sources, and then on top of the 100,000, let's say you had a $50,000 requirement of distribution. Well, now you don't have that 50,000, so now your only income is here. Well, think about it. You've been taking RMDs. Now you're going to have a drop in income for 1 year, and then it's going to come back up when the requirement of distribution start again. This year, when your income is down, might open up an opportunity for Roth conversions. So definitely be thinking about that. All right, let me come back. Okay, that's what I mean by create space for Roth conversions. Number 4 is student loan payments. Payments can be deferred all the way to the end of September now, and they don't accrue interest during that deferral period. This is kind of a no-brainer, but you do have to request it to stop those payments on the student loans and benefit from this. Number 5, charitable contributions. So many of you listening right now may be doing standard deduction instead of itemized, and you're like, gosh, that's a real bummer. I can't benefit from my charitable gifts. Well, just for 2020, I know it's small, but they gave it an above the line deduction for $300 for charitable gifts. So that means that even if you're doing standard deduction, save some receipts, because up to $300 you can deduct on an above the line deduction for charitable contributions. Number 6 within the CARES Act, the SBA Paycheck Protection Program. All right, so if you are a business owner, this program allows business owners or small businesses, meaning 500 employees and less, to get a loan from the government through the SBA of 2.5 times the average monthly payroll. Now, it's kind of still up in the air whether that's for 2019 payroll or the trailing last 12 months. Anyway, coming to a theater to you. And this is like really hot off the press. The SBA is still getting some of the questions answered and regulations out to the banks for this program. So stay tuned. Hopefully it'll open up either today or Monday and get going. One of the big benefits here is that the loan that it is utilized to pay employees and maybe rent and other features can be forgivable if you maintain the same number of employees during that time through June 30th. Loan forgiveness is a big deal. So in order to qualify for that loan forgiveness, application's got to be in by June 30th. The loan can be extended over 10 years, maximum interest of 4%, and payments can be deferred for 6 to 12 months. Let me speak a bit more about the loan forgiveness. So what that means is it's for the 8 weeks right after the infusion of cash, the loan comes into the business. For those first 8 weeks, then the payroll costs that are paid, rent and utilities and group health insurance, the portion of the loan that it is utilized for those pieces are forgivable. And any debt that's forgivable is not taxable income. Notice that down there at the bottom. That's a big advantage for small business owners if they can utilize this to keep some employees, right? And I think the reason why it had bipartisan support and Congress put this in place is if they're able to get some cash to small businesses so that they can pay employees for a period of time, that prevents them from having to go on unemployment. All right, that brings me to the 7th category, which is self-employed and unemployment benefits. Let me start with self-employed. This is a very unique. Historically speaking, self-employed individuals cannot file for unemployment, but with the CARES Act, they can. So, I don't know, take a barber or a hairdresser. If they're shut down and they can't earn income, then they can actually file for unemployment. Second is the self-employment tax. A quarter of that can be deferred till 2021, and another quarter of it can be deferred to the end of 2022. So half of that self-employment tax can be deferred into future years. That helps with cash flow in reducing some of the tax burden. Now moving to unemployment benefits. Traditionally speaking, there's a 1-week waiting period for once you file and claims unemployment benefits. That has been waived with the CARES Act. Now it depends on the states, but most seem to be adopting this. And then look there at the bottom. As a part of the CARES Act, the federal government has said, hey, we'll come in behind the states and add on an extra $600 per week. So in Florida, the base is $275, add $600 on top of that, and now you're at $875 a week. Now, if you did the math on that, $875 a week is somewhere around $40,000 to $45,000 a year of annual income, and that's, I don't know, $22 an hour, give or take. There could be somebody that was earning, let's say, $15 an hour, and if they're on unemployment, they'll be earning $22 an hour in essence. That could be an unintended consequence because on the back side of this, things start to recover. There might be some people that are disincentivized from coming off of unemployment to actually get back into the marketplace. We'll see. All right, let me come back to our slide. So that's the unemployment benefits. So what do we need to be doing now? So the way I would orient to this is which of these 7 and more than one could actually apply to you. Number 1, are you going to get a rebate? If so, what do you do with it? And then if you haven't filed your 2019 tax return and your 2019 is lower income, then you should go ahead and get it filed so you would apply for, or be available to get more of that credit. If you need liquidity, one place to take it from would be a retirement account. May not be ideal, but you can do that without the 10% penalty and then pay that back over the next 3 years. Remember, there's no required minimum distribution due in 2020. All right, so if you were going to have one, what does that open up for you? What new planning opportunities? Student loans definitely need to take action there, defer for into September, and then the interest doesn't accrue. Charitable contributions, everybody should keep their receipts, because even if you're doing standard deduction, you're still going to get at least a $300 above the line deduction. Business owners, be aware, talk with your bank, lending institution about the Paycheck Protection Program. And then self-employed, if you're self-employed, there's new opportunities there if you do need to go on unemployment and deferral of the self-employment tax. And if you're unemployed, there's a boost in terms of the unemployment benefits from this CARES Act. All right, CARES Act requires action, as I like to say there. Okay, so let me take a breather here and let's check in to see if there's been any questions. All right, let's see. Okay, yeah, we got a couple here. So first is, the question was, with unemployment benefits, do I get 2 separate deposits, one from the state and one from the federal government, or will it be combined? Great question. My understanding is that it's all run through the state, so it come from the state of Florida, but that the Fed is backing up the state of Florida, so that's where the additional benefit comes. Now, here's something that I'm seeing that's a little bit interesting. If you think about it, what if you have a loved one or you file for unemployment, I don't know, the 2nd week in March, and then the CARES Act didn't pass until last Friday. There's a period of time there where there's a gap, right, where you may only got the $275 a week. I think the Congress's intent is to back pay that, so that $600 would be made up for going back to when you first took the benefits. But it would all come through the state of Florida because the federal government is backing up the state of Florida on those unemployment benefits. All right, let's see if we got another one here. So let's see. Question was, if I did a Roth conversion earlier this year, can I use the COVID-19 hardship provision to pay it back and then redo the conversion? Great question. So what they're aimed at there with that question is, if you remember, a part of the CARES Act, you can withdraw from a retirement account and waive the penalty, and then you can pay it back over 3 years. But the IRS looks at intent, right? So if your intent when you did the Roth conversion was to do a Roth conversion, and then you try to pay that back using this, though, they would argue, no, you didn't intend to take it out for a hardship withdrawal for COVID. You did it for the Roth conversion. So I don't think that would work out well. But good question. All right. And then how do I know when is the best time to do a Roth conversion? let's hold that question because I'm going to address that on the what to do now checklist after the bear market conversation. So, okay. All right. Well, hey, keep the questions coming. I'm sure I'll have a few more here after we go through our next talk. So let me get things set up here. So I'm going to move to the bear markets, opportunities to seize today. And let me do that and then share my screen again. All right. So I call this fear the bear. Look, when we're in the middle of a bear market, it is not easy, especially if you hear on the news or you open up your account, you see the red numbers, or you see the losses in your investment portfolios. I don't care how short-lived the bear market is, it's always painful. The other thing that I would say is internally, we call this volatility fatigue. And we're maybe 4 weeks into a little bit longer, maybe 6 weeks into the current bear market. Historically speaking, that's fairly early. It could go for a period of time longer. We don't know. But with that, I just invite you to prepare yourself, right? So if in advance you're like, you know what, it might go down more, but that's okay. And know your plan and know why you're invested the way that you are. And watch out for volatility fatigue. And that might be where it's like, okay, I made it through 4 weeks, 6 weeks, 8 weeks. I'm doing okay. But if it continues, keep watching your moods with that and stay centered. All right. So what is a bear market? A bear market is a 20% fall from their peak. And if you look at the S&P 500, going back to 1926, we're in our 12th bear market over that period of, almost 100 years. So bear market is a 20% decline. Now, one of the things that I hear about this bear market, but I also hear every bear market, including the financial crisis, is, yeah, but David, this time it really is different. The crisis now is so unique and different. I agree. It's always different. When we faced the Great Depression, we never faced that. When we faced World War II, we never faced that. When we faced the Kennedy assassination, we never faced that. Cuban Missile Crisis, we never faced that. The financial crisis, we never faced that. It's always different. And another way to say that is the circumstances surrounding the drop are never the same. I love this from Mark Twain. Courage is resistance to fear, mastery of fear, not the absence of fear. So my purpose for historically looking at bear markets is hopefully it'll give you perspective to build your courage and your confidence. All right, so how are we going to work through this? We have a 70-30 index fund portfolio, just a hypothetical, so we can kind of do some comparisons. You can see it's broken into some stocks and bonds. 70% stocks, 30% fixed income, which for many of our clients, that's pretty similar to the way they're allocated. All right, so first bear market we'll look at, the Great Recession. Housing prices declined, mortgage-backed securities became unstable, banks needed immediate liquidity so that they didn't fail. And you can see this one went for about 18 months down there at the bottom, and it declined somewhere around 57% during that time. Despite this decline, what happened if you had invested at the high? Let's take a look. So you can see that if you invested at the high there in 2007, here's the big drop. And then notice the increase of a 70-30 portfolio. Not only did it get back even within 3 or 4 years, it outpaced inflation very soon after that, and it gave you a positive return. I put this Time magazine cover here because you'll see a reoccurring theme. In the middle of bear markets, the media always is bringing forth, why this time is different, right? And why investing is not going to work, or why stocks aren't going to work. So that's why I put this in here. Notice the returns off of the bottom, and they come aggressively. 1 year after the market bottom, up 68%. 3 years compounded at 26%. 5 years it compounded at 14%. And 10 years off of that bottom, it compounded at 10%, which means you more than doubled your money during that period of time. Big time returns and aggressive returns. All right, let's go to the .com. Lots of speculation, internet companies without profits. Look what happened. We had a plunge of 50%, and the duration of this bear market was almost 30 months. So again, a prolonged period of time there. Here we go. There's the big bear, the big bad bear. But notice that our diversified portfolio actually didn't do too bad during the big sell-off driven by the .coms. Here's the financial crisis. But even with the financial crisis and with the .com, you still went from, let's say, $1 million to somewhere around $4.5 million. Tremendous growth in your wealth if you stayed invested. Look at the returns, 34% 1 year later, 15% 3 years later compounded, even 10 years out, 6% compounded growth. Let's go to the next one, the Black Monday, right? Crash, Dow fell 23% in 1 day. The overall fall was somewhere around 33.5%. Duration, though, was pretty short, only about 3 months. But look at the recovery. There's the big fall, but very soon after that had recovered, and actually, again, we're beating inflation, which was much more substantial at that point in time. Returns coming out of the bottom, again, handsome returns, 21% for 1 year, 16% compounded looking 10 years out. All right, here we go. Look at this. Fed raised interest rates to almost 20%. Seems incredible compared to today's environment with interest rates. But there was hyperinflation going on. They raised these rates, and then we moved into a period of stagflation. Notice the bear market down around 28%. Duration was just short of 2 years. But once again, strong recovery coming out of it. And look at, even though we still had high inflation, a 70-30 portfolio still dramatically outperformed. And big, again, compounded in returns off of the market bottoms. All right, let's go next to the oil embargo. Energy prices soaring, right? A little different than today. But you can see that during that time, we saw a 48% decline in that bear market and a 21-month duration, almost 2 years again. How about the returns? Even with the hyperinflation going on, it still got back to even in dollar amounts within a couple of years. And then it still beat out inflation over that like 6, 7, 8 year time period. In terms of the returns, again, a strong aggressive rebound off of the bottom. All right, let's go to the Cuban Missile Crisis. Look at this picture down here in the bottom right. I found this, look, I wasn't even born when the Cuban Missile Crisis came about, but I remember my parents talking about it. And just the thought of having nuclear missiles that close to the United States pointed at all of our major cities. Talk about a fearful time. And you can see it triggered a bear market. Loss of around 28%. Duration, though, pretty short, only about 6 months. Let's look at the rebound. Big time rebound. Again, high returns within just a few years. And again, a big bounce off of the bottom, and you're rewarded for holding your portfolio. All right, let's go to the granddaddy of them all, the Great Depression. I know this is startling, but the loss of the S&P 500 was 86% spread across the 3 year period. Dramatic losses. Now, did it recover? I gotta admit, this kind of surprised me when we put this together. And Danica and Lauren helped with this, so shout out to them. So look, the blue line is the huge fall in a 70-30 portfolio, all right? The aqua line, though, is the consumer price index. Notice that your portfolio got back to where inflation was within just a few years. And it even increased and went above where you put your money in, where you started, within roughly 6 or 7 years. So even when it was the most dire of situations, if you could wait out and hold the portfolio for 6 or 7 years, it still had a positive return. And look at the rebound. Oh, I'm sorry. Let me move next to currently, right? The COVID pandemic. The high was back on February 19th. And so far we have a 34% drop, and we're roughly 2 months into this. So historically speaking, we're pretty still early in the bear market decline. And I don't know where the bottom is, But given what triggered this particular decline, you could argue that we should have a fairly short rebound coming back because the economy is so healthy coming in to the bear market. We'll see. But what I wanted to share with you is kind of put the COVID into perspective is look at this dollar growth chart going all the way back through these times. So this is if you put in $1 or $1 million back in 1926. Here's the big fall of the Great Depression. Look, here's the financial crisis. And look, I know we're going to have a dip here with COVID, all right? But despite all of that and everything that we've faced, we can see there's been an ever onward march up of equities, and a dollar turned into over $10,000, dramatically increasing your purchasing power versus inflation. Now, some people might say, well, yeah, but this time is different, right? Well, let's take a look at that. Maybe this time is still the same. So what is the same about equity investing today as it has been for the last many decades? Well, number one is, how many crises have we recovered from? All of them. The next 100% move is always up. We may not know the next 20% move, but we know the next 100% move. Some people say, well, David, can't it go to zero? If it goes to zero, there is no food, there's no gasoline, there are no banks, there's no government, there's no businesses, period. Human beings are extinct. So the next 100% move is always up. Number three, the only way to lose is to sell. Now, let me speak to that for a second, because one of the things we do in our portfolios for our clients, if you remember, many of you have a portion that's in equities and then a portion that's in fixed income. Well, when equities decline, the fixed income that we use in the portfolio remains stable. And the reason it's so important is if you need to take a withdrawal out, we'll take it out of fixed income, which gives plenty of time for equities to hit bottom and then recover. That's the important of, we never sell anything at a loss. All right. So that's what the way the portfolios are designed. All right. And then number four, magazines and the media create panic and fear. Remember how they earn income or earn revenue. They sell advertisements. So the advertisers pay the media for the privilege of advertising the programs. And what the advertisers want to see is ratings. So look, we absolutely need to stay informed, be vigilant, make good decisions, pay attention to the situation. But it can be harmful to you as an investor and harmful to your centeredness and your calm if you're too connected to those communications from the magazines and the media, because they tend to knock us off center. Number five, let's think about this one. All anxiousness and fear and worry is already priced in. So what do I mean by that? What if you're worried like, gosh, we already got 10 million people unemployed. I'm worried it's going to go to 20 million people unemployed. I had that concern too. Probably everybody here on the call today does. So if we have that fear, or you have that fear, most likely other people have it, and it's already priced into the market. So one of the things that we've been seeing with the equity markets is that when the White House announced that they were pushing the period of time out to the end of April, where they're going to kind of keep things closed down, we saw a big sell-off in the markets the next day. And the reason for that was investors, when they invest in equities, they're buying future expected earnings and revenue. And when the situation changed, they're like, oh, well, the companies that I own, it's going to be longer now before I can actually get income or revenue or profits. Then they sold those equities off. All right. So that, think of the equity markets, they're very liquid, millions of transactions a day, and they're pricing in where they expect profits and revenue to be in the future. And all new information is priced in immediately. And it's very, very effective. So remember, if you've got concerns or fears or worries, it's already priced in. Number six, recoveries come very quickly. you've got to be invested to get those returns. And you saw that with each of the bear markets on those recoveries. They were pretty sharp and pronounced. And last but not least, I think this is another reason for hope, trust, and confidence. The equity markets recover, historically speaking, 3 to 6 months before the recession ends. And the way to think about that is the equity markets are a leading indicator, again, because it's so liquid and people are pricing in expectations of future revenue and future profits, okay? So historically speaking, the equity markets rebound 3 to 6 months before the recession ends. And look, it looks like Q1 will probably be a small negative. Q2 is going to go way down in terms of GDP. So that by definition is a recession, two quarters of GDP being negative. Look, in Q3, what if things start to free up and open up a little bit? We're coming off of a really sharp decline of Q2. It's very feasible that Q3 actually comes back up a tad and then Q4. Well, so that would mean the recession would, in that example, end at the end of June. Then you can make an argument that the equity markets should be maybe already at its bottom or getting very close to that. So that's a thing to hang on to is remember, equity markets rebound and recover 3 to 6 months before the recession ends, which makes it really hard to time. So let me finish this little talk on the bear markets. Going back to one of our 4 words, remember the 4th word was faith, which means trust and confidence. And I think a lot of people have, maybe they don't speak it this way, but their fear is, well, you know, David, what if we don't have a recovery? Like, why should I believe or trust or have confidence that there is going to be a recovery? And the best way I can explain this is remember that when you're investing in equities, you're not investing in some mystical thing. You're investing in people just like you, just like me, just like us here, that go to work, look for ways to be helpful, to innovate, to come up with new products and services, to cope with new situations, to handle certain breakdowns. That is what is so unique about us as human beings. We are the most adaptable and creative creatures on the planet. And that is one of the reasons why you've seen an ever increase in equity prices is it's human beings coming up with new products, new services, new offers of help, new innovations, new creations, just to help others. And I think that the reason to trust in a recovery is once we get on the other side of this crisis and people start getting back into work and engaging, they're going to be eager to look for help. And look, getting back into the restaurants and whatever that might be, people are slowly going to start getting back to a normal life, and that will be positive. And then you'll see the ever onward march continue forward. So, all right, let me switch back now to a couple of other slides it has. Sorry, and let me come here. And all right. So I'm going to hit this checklist and then check in to see if we have a few more questions. So with the bear market, what do I need to be doing now? Number 1, stay centered and calm. Watch your narrative. Katie and I have to be intentional about this. We kind of have I hate to say rule, but what we're doing is we might watch 15, 20 minutes of news in the morning, maybe a half hour in the evening, but not being glued or connected to it 24/7. Because it does knock us off center and take away some of that calm. All right, number 2, think forward and seize opportunities. Hopefully today has really helped that with the CARES Act and then also with the bear markets. Number 3, add capital and keep buying. So if you have made it through or are making it through this downward turn and you still have income, absolutely keep putting money into your qualified plan. If you have cash available, keep investing. Think about it is where prices are today are at a sharp discount still compared to future expected returns. Number 4, 5, and 6, I put these into a bundle because we're already doing these things with clients recurrently. Number 1 is tax loss harvesting. That's where we sell a position at a loss to capture those losses to help with taxes, and then immediately buy a like-kind position so that your portfolio is not out of the market. Number two is or number five there, Roth conversions, right? Be converting pre-tax dollars to Roth dollars today. And, let me speak to that for a moment. I think today is kind of the perfect storm for Roth conversions. And here's why. Number one is tax reform of 2018 lowered tax rates to where they historically haven't been this low in many, many decades. Number two is that with the equity market decline, let's say you're considering a $10,000 Roth conversion in January before the fall. Well, now that position of equities might be worth $7,000. And when you convert that $7,000 to Roth, then you're paying tax on the 7, which is a 30% discount in the tax liability versus just a few months ago. So that when equity markets are down, that's a good time to be thinking about Roth conversions, because once you move the equity positions over, then all the future growth and earnings is going to be income tax free. Third reason is because of those RMDs being relaxed, right? So we talked about if you are taking RMDs, you don't have to this year. That might be an opportunity where your income actually goes down for 2020. And that might be a good time to be doing those Roth conversions before your income tax bracket comes up. And look, if your income you expect it to be down in 2020 period, this might be a good time to be considering doing those Roth conversions. So that's why I kind of think this is the perfect storm in a positive way for considering Roth conversions. All right, and then rebalance. This is something that we're considering over time. That's where you sell a little bit of fixed income to buy a little bit more equities, right? Because fixed income has stayed value, equities are on sale, sell a little bit of fixed income and buy a little bit of equities. And last but not least is keep the faith, keep your trust and confidence, stay centered, focus on these opportunities to seize today to make your successful future look even brighter. Okay, let me check in to see if we have any additional questions. All right. Yeah, here we go. So David, how do I know when is the best time to do a Roth conversion? So I just kind of talked about the perfect storm of the Roth, right? It's very compelling, but it really depends on your specific situation. So the way to think about that is, let's say that you, if your income is going to be down compared to other years, what we could do is we'll figure out how much conversion to do to bump right up against the next tax bracket. So it's a way of strategically picking the appropriate amount to do in that Roth conversion based on your tax bracket. So it is specific to your situation, but fundamentally, this is a good time to be thinking about it. So good question. All right, let's see here. With all the government spending, yeah, 2.2 trillion, right, with the CARES Act, and they might be just getting started. With all the government spending, do you think it's safe to assume future tax rates will be higher? Yes. To be honest with you, let's talk about what we do know. We do know already that with tax reform of 2018, rates dropped, right? Personal rates. But in 2026, they sunset and they automatically go back up, roughly 3 or 4 percentage points. So we know that that's coming, even if Congress does nothing. Secondly is when the government prints money and borrows from the future, the only way to pay that back, there's really only two ways, is either one, grow revenue, which means the economy is growing and people are paying in the taxes to make up that deficit. Or number two is increase tax rates, right? And to pull more tax revenue in out of the marketplace. I have an opinion on which one is better, but set that to the side for a moment. So that's really the only two ways to pay it back. So I think it is very safe to assume that future tax rates will be higher. All right, let's see here. Let's see if you have any other questions. Oh, this is a good one. Okay. With more government spending, what does that mean for our investments? Thank you. Good question. So think about government printing money, right? The 2.2 trillion with the CARES Act. Let's go back in time to the financial crisis, and there was quantitative easing, if you remember, and there would, it was billions, and they would come up with quantitative easing 1, QE2, and so on. What happened in the financial crisis, though, is M1 money supply, which is the Fed printing all that money, went up substantially. It spiked, but M2 money supply stayed fairly level. M2 measures how much of that money was getting out to the marketplace in terms like all, coming out from the banks out to the consumers, out to businesses. It really didn't go up. This time is different because the rebates are going straight to the consumer, higher employment benefits going straight to the consumer, the SBA loans going to businesses, right? So there's going to be an influx of new cash into the economy. And so if you think about it, let's say that dollars in the marketplace stayed the same, and because it kind of makes up for that gap. And then supply, though, like the products and services and productivity has been shut down. If you have more dollars chasing after fewer products and services or fewer supply, that's inflationary. So look, I don't know that for certain, right? That's kind of what I'm anticipating or thinking we'll see. And this is after the recovery occurs, right? And things are coming back. But if we have inflation, let's say longer term, then what does that mean for our investments? And fundamentally, there's only 4 asset categories for investing. Cash, which includes like your savings and your CDs, fixed income or bonds. Number 3 would be real estate. And then number 4 would be equities. If you have inflation, you certainly don't want to have too much in cash because it's losing its purchasing power very rapidly. Fixed income, it depends. Sometimes it can barely keep up with inflation, but a lot of times it doesn't. But real estate and equities, those two, historically speaking, have outpaced inflation in the long run. So look, if you're a client of ours, that you're already positioned that way to have an allocation to real estate and equities to be somewhat protected if we do have inflation after we have the recovery. So, all right, let's see if we have any other questions. Okay, doesn't look like we do right now. But look, we're here to help. I'm sure some of the ideas you learned here today will trigger more questions. By all means, send them over to us. And we are recording this. And if you want to send this to a family member or a friend, let us know. We can get you the link for it. It was good being with you today. Remember the four words I wanted you to start with and write down. So stay centered on what matters, your relationships, your marriage, your family, you name it, what matters to you. Number 2 is stay calm, right? That helps us make good decisions. Number 3 is keep being forward thinking. Think 2 months out, 6 months out, 2 years out, 10 years out. And last but not least is that faith, which is that trust and confidence that yes, a recovery is on the horizon because that's what human beings do. We're adaptable and we're creative. All right, it's great being with you today. I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors, and we'll see you soon.